Welcome, Blockhead traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to form your own financial opinions and come to your own financial conclusions. Today is Wednesday, August 25th, and this is Blockhead Traders Weekly. In this week's episode, I'm joined by fellow Blockhead trader ViperXL007, and we're going to be recapping the plays that we actually jumped in following last week's episode on SESN, SESN ticker. So if you recall, that is the ticker that basically went from $6 to 86 cents in one tick. We reviewed it in last week's episode. Go back and take a look. And in last week's episode, we laid out a potential play and we jumped in. After we talk about SESN, we'll give a mention of two other tickers we're kind of chasing and watching and playing in flight. But before we get to that this week, let me give a shout out to our Discord channel as well as our Theta Gang link below. In the description below, you're going to find a link to our Discord channel. It's a free and open Discord. Anybody is free to join. We got a couple of fellow Blockhead traders in there that would love to chat about what you're trading, answer any questions you might have. We'd love to hear from you, know what you want to hear on the videos, what type of concepts you want us to cover, things like that. As far as the Theta Gang link, that is a link where we are fully transparent. They are my trades, Sprocket 888's trades, the good, the bad, and the ugly, the winners, the losers, and the duds that just don't go anywhere. But let's hop to this week's episode content, SESN. So last week we had SESN and we talked a lot about it. So go back and check out last week's episode. And we talked about a potential play. And turns out, for the show, we decided to enter this trade. So let's talk a little bit about the play that we put on. Now, if you recall, during last week's episode, the call buying, I was much more comfortable the higher the delta was that we got on our strike. SESN didn't really open with the type of strength that we wanted to see. It didn't really pull away from where its close was on Friday. It kind of slowly bled down on the following Monday when we actually put this trade on. But it seemed like a good experiment, so I went ahead and placed the trade anyway. And so what I did was around lunchtime, I checked the ticker and it wasn't really picking up to take off, but it also wasn't really getting beat down. There was tons and tons of volume, just kind of suspending it where it was. And so at the time that I made the trade, the underlying was around $1.40 a share. And just like we talked about in the episode, went ahead and bought $31 calls because I wanted to play this synthetically long 3,000 shares. Now, like I always mention in this podcast here, that you should always have an exit plan. And exit plans are not just bailout on the way down, they are also exit plans on the way up. So you know when to take your profits and where it is time to step off the train. So as I mentioned, we bought 30 calls, $1 calls each. I paid 78 cents a piece for those calls because the underlying was at $1.40. That was about 40 cents of intrinsic value in those options, and about 38 cents of that was extrinsic value. Now, that basically took my total out of pocket at $2,340 for the trade. So what's my trading plan? My trading plan in this is to basically sell monthly calls against my long 3,000 share position. And I will do that at close to the money strike as I can, as long as it's above my cost basis. So I will not sell calls below my cost basis, because if I was to get assigned, I would be losing money, and I'm not going to do that. So on that particular Monday, when I bought those long calls, we were still kind of up there around $1.40. However, it looked like the underlying was weakening. So I said, I'm going to go ahead and get in and sell my first round of 30 calls at $2 strike. So I sold 30 September expiration calls at $2 a strike, 15 cents a piece, collecting $450. Now, remember, at the end of September, third week in September, those calls, if the underlying is not above $2, they will expire worthless. I will keep every penny of that $450, and I will look in October to sell another call. Now, I'm going to try to hold off until SESN maybe rallies up closer to $2, so that $2 strike is closer to at the money. But I'm not going to wait too long, because remember, theta is working against me in this trade. So every day that I'm not putting something against my calls, those calls are just kind of bleeding down. So I will be trying to put a call against that above my cost basis. So what's my upside exit plan? Basically, my upside exit plan is to get assigned at whatever call I most recently sold. So right now, my exit plan is to be assigned at $2. So I want SESN above $2 before the third week of September. And if it does, I will basically have a profit of about $2,310. And the way that I arrive at that is I will be assigned that $2 calls that I sold. So I will receive $6,000 from the buyer who exercises those calls against me. I will have my $450 that I collected in the premium for selling the calls. Now, I don't actually have 3,000 shares, so I'm going to need to exercise my February calls at $1 a share. That's going to cost me $3,000 to do that. And then I'm going to have the other expense of $1,140 of my extrinsic value back when I made the trade. If you remember, extrinsic value is the value that you really won't ever get back unless you sell the option back when there's some theta left in there. But because I'm taking assignment and exercising early, I will basically forfeit that $1,140 and not get it back. So that brings my total haul here at $23.10. Now, if we stay below $2, I'm going to rinse and repeat, and this profit target will change as I collect more premium, either sell another $2 call, or if I'm really lucky, I'll get to sell calls above $2 to even push that upside exit plan even higher. So that's the rosy part of the trade. Now, what is the exit plan on the downside? Well, like I said, this is call buying, and when I'm buying calls, I really need to be able to stomach the loss of just flat out the calls going worthless here. So the exit plan is, there is no exit plan. These things are going to expiration or going to when SESN hits the ground at 0. So I will right there be losing $1,890 on this trade. Keep in mind, I have lowered my loss, because if we go to 0 or go to expiration, never getting assigned, I still keep that $450. So as you can see, with each call that I'm selling through all these monthly iterations, I'm going to be working down that maximum loss on this holistic trade. So that's the game plan that I have going. Viper, I believe you also entered this trade, if I'm not mistaken.
It is true. So I entered it as well. I entered it slightly lesser. So I did 10 contracts. And some of the motivation behind that was, you know, we've talked extensively, and we'll continue to talk extensively, and we'll always bring it up. Risk mitigation, portfolio sizing, all that kind of stuff. And as our long-term viewers may recall, I was in the trade in the crash, and so I'm already carrying into this a pretty hefty loss. And even if this trade goes perfectly right, I'm not going to recover all that loss. And that was intentional, because revenge trading is a thing, and you don't want to get sucked down that rabbit hole of trying to chase back and, you know, really, you know, go back at it and, you know, chase what you lost and still get your gain. So my motivation in getting into all of this was not to recover all my losses. If everything goes perfect on this trade, you know, maybe I'll get back half of my losses or something like that. And that'll be great, because then we'll be more towards what was tolerable on the initial trade. And the other reason I got into it was because this is just, sort of a unique opportunity to really feel these waters out. So I'm also looking at my expenses on this as a learning tuition, because like this is a unique opportunity. We're pressing up against rock bottom. And so what does that mean going forward? Now, 100% rock bottom, zero, bankruptcy, that's all possible. So it's not like, oh, we're up against the bottom, so it's only going to go up. No, there is definitely the downside that was mentioned here, but the downside is not off a cliff and then there's not a whole nother canyon below. We're already there. I already fell off the canyon, down in the sweltering heat at the base of the Grand Canyon. So let's do a little learning. So that's mostly what brought me into it. And yeah, I mean, so far it's going well. Those September monthlies that we sold are whittling down. I mean, they're down to 5 cents, I think, last I saw. So first month potential check, but it'll be interesting going forward from here as to what happens. On the other things that I've been keeping an eye on, I've returned to an old flame in the ticker MVIS. This is one that I believe Sprocket got me into months and months ago. And it has a history of being a volatile ticker, which instantly makes it good for premium selling. And it happened to perk up on one of my screeners. So I just wanted to go over kind of what I saw in this and what kind of brought me into it. And then we can kind of see, if Rocket has any thoughts on this ticker before checking out what he's got going on. So let's hop over to my screen here. So here's history. Here's where we're at historically on MVIS. This is going back to end of 2020. And there are a couple key things that I marked out here. We have two main support lines here that are in blue. And we can see, these big spikes. I mean, this is just pure premium juicing when we get this kind of volatility. And this is significant. I mean, this spike here, $13 all the way up to $28 and right back down. So I do think you should definitely double check. Always, in this day and age, always double check. That could have been a main pump, Wall Street Bets thing. I feel like this might have popped up on their radar. But nonetheless, it juices the premium and, more importantly, price levels. So we have this one bottom here that I have at 950, 979. This was a resistance on a previous swing, and it was turned into support on all of these future swings. So on the order of price action and all that kind of stuff, that's important. We want to see resistance turn support and have multiple tests to confirm that. We have one more here that kind of started that it has been acting and tested as more recent swing supports. So to me, 1230 is a very solid price for this. So what I happened to see then, looking at this, was we had this decline from the most recent high swing, and we came down right here to 1230, came back up off of 1614, and we came back down. And so now this is where it perked up on my radar. The 18th is when I entered a trade, and my trade here was just a naked put sell, because this is the spirit of how I use MVIS, I guess. I don't know that I've ever really held many shares of it. The thing I love about this particular trade is it can go both ways. It could go shares because it's just swing trading, but it also shows the power of the naked put option that we constantly talk about. So what I did here is I saw we're coming down towards this 1230. I'm very confident in my probability of this level holding, given history. I'm very confident, of probability of the 979 holding. So I went and looked at the option chain, and sure enough, there was a $12 strike selling 75 cents, I believe, per contract. That put my cost basis. You have to double check the math. But it was near, this $9 or $10 range down here after I opened up 5 contracts, I believe. So I was very happy with everything I saw there, because I was counting on a pop up. Important to note now, on the matter of exit strategies, is I also identified what do I think this is going to do. And I noticed we have this clear resistance on the previous swing. So that's going to be an important level that it's going to react to. It could overcome it, but it's going to react to it. And if we retrace on the price, then that's going to hurt my premium potential. So my play the whole time was to wait until we got near this 1614, near this high, take a look at what kind of burn we had on the premium that I had already collected, and potentially cash out. Was pretty confident in it reacting to this level, like I said, because we have fairly consistent resistance at this level. There's not very much support. Let me shrink this down so it's a little easier to see. We don't get a whole lot of support at this level. So this is a level that it has overcome, but it doesn't really catch much support at this level. So I'm feeling pretty solid that this is going to be my exit strategy. I want to get in, sell a naked put, a handful of naked puts at the $12 strike. I want to bank on a rebound up off of this support level. And I'm eyeing this 1614 that when we get close, I'm out. Let's call it a day and see what we got. So today was that day. You can see this candle is just super wick long on the top. And that was because, sure enough, boom, 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 we go rising up. I'll spare you. You can check the chart for yourself, but it was intraday, early afternoon, mid lunchtime, somewhere around there, that we actually peaked at the peak of the wick here. And then it just started dropping off a cliff. So I didn't actually, you're never going to get the top, but I saw that it was coming up on this level. It hit everything I needed it to hit. 52% was what I kept of my premium. So I gave back 48% of the premium I collected. That's fantastic, to all the rules that Sprockets talked about on, good options, rules of thumb to go by. So I got out up here about 1550, I think is somewhere around where I closed out. And then sure enough, we closed on the day down around 1473. I could have still closed it. I could still be holding this, still be, up on profit, up on premium and whatnot, but we don't know what's going to happen. There is no red candle yet. So tomorrow could be another up day. We could go back up to 1614, but the play here was get close, close it out, capture a lot of that, premium, lock it in, let's move on. So that's what happened here. And I don't know if this is anything that's, I know Sprocket, you've perked up on MVIS before. I don't know if this is something that's hit your radar recently, or if you have any thoughts. I know my thought going forward is I'm looking for this retrace to see when it happens and how far it goes, and maybe I'll wash, rinse, repeat, but we'll see.
No, that's I actually haven't taken a look at MVIS in a while here, but that's a textbook beautiful play that you executed there. I know exactly the feeling that you probably had as you were watching it hit your price target. You're probably like, oh man, we're milking this premium down. We can go a little bit higher. We can go a little bit higher, but man, you booked your 50%, which is my rule in a lot of premium selling is you hit your 50%, you got your check, move on, play again. Identifying the swings there and selling that textbook, excellent play there. And
this was also important context coming off of the big SESN loss. So I was furthest thing from wanting to get greedy. Let's lock a win in, like you said, textbook. Let's count it and keep going.
Yeah. Actually, ironically, the play I'm going to talk about is very similar strategy, and it's identifying a a swing pattern, identifying a range that an underlying is trading in. And when you're at the bottom of that range, that's time to sell the put. And when you're on the top of that range, that's time to take the put off. Or if you're a little bit crazier, like in my play, you might sell a call. But let's take a look at what I've got cooking here, and that is futures trading. I love futures trading, and it is something that I am really trying to start kind of baking into more and more of my portfolio. And I'm not actually trading the futures themselves. I am trading the options on the futures. And a couple of my most favorite products are the indexes to trade in futures. And the reason for that is indexes are a little more, let's call them slower moving than what the other futures could be, the commodities, the wheat, the soy, the oil, natural gas, things like that. So I have been keeping my eye on RTY. Now, these are the futures for the Russell 2000. And, you know, I don't have the charting trading view levels that Viper talks about, but the thing that's really worked for me when I'm looking at my charting are moving averages. So on my charts, I basically have a 21-day moving average that is in green, a 50-day moving average that is in yellow, and a 200 moving day average in red. And the play that I have on the Russell here is, for a while, if I kind of zoom out, the Russell was really just on a tear. And back around March timing, the Russell really kind of started stalling as far as its growth, and it started trading sideways. And so I started watching this thing for strangles all the time. And most recently, I keep an eye on the volatility of the indexes. So the one thing you have to be careful of is volatility can get pretty stinking low on indexes, especially when they're in long bull runs like the S&P is currently on, like the NASDAQ is pretty much currently on, and the volatility is just not high enough for me to be worth the risk. So on the index and futures, I really like it when we're over 30%. On equities, it's quite a bit higher that I like to see on the implied volatility, but on indexes, I'm pretty good with 30%. And the one thing that we've noticed, or I've noticed, basically since around, I'll say, beginning of July, is we started breaching down below these moving averages, and the moving averages started coming resistance points. So you can see here we kind of rallied up and started pushing against the 50 and 21 day, and we dropped down. The 200 day was kind of a little bit of support here, and we kind of went back up to these moving averages, and we're pushing back down, challenging up, pushing back down. And so what I identified is, hey, if we get a pullback down here close to this 200-day moving average, I'm pretty confident that 200-day moving average is going to hold. Now here, I don't just use my technical analysis on the chart. Because this is an index across the Russell, I'm basically kind of in tune to what's happening in the world at a very macro scale. And, you know, we have the Delta variant out there kind of causing a little bit of turmoil. We have a very loose monetary policy with tons of liquidity floating around. Economic, you know, you hear about inflation kind of kicking in. You hear about, you know, companies can't finding employees to work. So I think a lot of this, the liquidity that's out there in the market really wants to tilt things bullish, but the Delta variant kind of puts a little bit of a drag on it. There's a lot of unknowns. And so all this to me says, you know, this isn't a full-blown bear quite yet, but it's also not a bull run. So to me, I'm like, horizontal is the way you play it. I'm going to wait till this thing drops down close to the 200-day moving average, and I'm going to look to sell probably a 16 to 20 delta put. Now, I wasn't quite sure how close to that 200-day moving average we were really going to get before it starts to pull back or turn around, according to my thesis. So like Viper says, like I say, you're never ever going to buy the bottom and you're never ever going to sell the top. So when you're happy with the premium, go ahead and pull the trigger on the trade. So on August 18th, which was actually here on this candle, I entered the trade probably around a 21.45. It was towards the bottom of this candle when I entered. I sold a naked put at 2100, which wasn't, it's below the 200-day moving average. I actually got a little aggressive on this delta. So a lot of times when I touch futures, I try to stay below 20 delta, 16 to 20 delta, because go see the soy disaster episode. Going with higher deltas can really, really eat you up in the futures world because you're playing with very large notional values. But I believe I entered this at a 35 delta and I collected $44 in premium. Now in futures world, you have to divide that by 2 for this particular underlying. So I collected $2,200, selling short at the 2100 strike. Now that's great. That's wonderful. Got a little sad the following day when we started coming down, but I'm kind of watching this 200-day moving average. Now, one thing that you'll recall if you go back and watch the soy disaster is my thesis is this 200-day moving average is going to hold. If this 200-day moving average was going to be breached, I'm going to take my loss, pack my bags, and I'm going to head home, because I didn't do that in soy when I saw the red flags, and I ended up writing a much, much bigger check than I should have. However, lucky for me, my 200-day moving average held, and we went on one heck of a tear on the Russell. So if you kind of notice down here, this is the implied volatility. You can see when I sold on the 18th, we were up here close to 30%. It was very, very close for me not making the trade because, like I said, I like my index volatility above 30. On that particular day, it was almost a 30, not quite, but I was pretty confident in my moving average, and I knew as soon as we started to rally, that volatility would shed off. And sure enough, it did. As you can see, it rallied. The volatility drops back down. Around 22 is where it sits. Now, the next leg of the play, which I actually put on just yesterday, was I called the resistance level at probably around 2250 was where I was predicting strong resistance to deflect the Russell back down. I didn't quite get to 2250, but yesterday I sold a call, basically went out, and this time I don't mess around on the call side. I definitely went out to a 15 delta call and sold a 2310 call, collecting $850 in premium. So divide that by 2, another $425 to put a cap on the call side. Now, these are all in September expiration, so they're going to expire on September 17th. And so I wait for this swing to come up to where I believe it's going to turn south and basically go back down, bleeding premium. So if I take a look and share my P&L chart with you, what I have effectively done is I then cap the bottom here and cap my top. And what you can see in this gray range is this is the 1 standard deviation expected move before we get to expiration. However, I am probably going to be exiting this thing once I hit about 60% profit. I go a little bit higher on futures, especially when I am so far in the middle. The reason that I'm a little bit okay with selling naked calls on indexes is because, yes, they can move big, but they are not like an equity. You are not likely to wake up tomorrow morning and see the Russell up 35%. So I'm pretty comfortable with this risk and this spacing from 2310, especially given the recent trend in the Russell. You can see that my theta for this particular trade is 64.87, which basically means I am collecting $64.87 just by letting this thing hang out there each day in theta decay alone. And it will only speed up as we are approaching the under 21 days to go to expiration. So that is my Russell trade that I most recently put on. And just like Viper, it is following, identifying a swing pattern in the chart and then selling the put when you're at the bottom. And in my case, I sold a call when I went to the top. I will advise you on naked calls to please be careful, because those things are one of the very few things that have unlimited losses.
Is the exit strategy here to close your leg? Because obviously a put and a call are earning their maximum value in opposite directions. So is your call to, or your exit strategy to close each leg separately, or are you kind of adding it all up and just saying, all right, here, just let's go, let's get out and run?
I will probably close this all together, but I have done what's called legging out, and that is where you close one side but not the other. What I basically don't do is I don't leg out on the top side. And the reason for that is it's really easy. I shouldn't say it's really easy. It's easier to roll a naked put forward than to mess around with a breached call. So if I'm going to leg out, it might be when the underlying is really, let me pull up the P&L chart to kind of show you here. So if for whatever reason the Russell started dropping really fast, really far, and we started kind of coming down here into the lower edge range of this strangle, that call is going to be worth pretty much almost 100% of its value down here. So I would leg out at that point and close the call side, keep the put open. If I started breaching down, I would consider rolling the put. Because you can roll for more premium. I've already a ton of premium has come off of this already, but because this is a really kind of iffy trade going in, means the volatility really wasn't as high as I normally would like it. It was right on the edge. I would probably just shut this down, book my gain, and move on. So as you can see, the max gain here is 26.25 the way it stands now. So I'm probably targeting around 60% of that to walk away with.
Gotcha. Yeah, definitely. I can see the appeal to, we'll call it very loosely, stability of the index. Like you said, that you're not going to get a Wall Street bets pump on an index. So I definitely can appreciate the stability of that. I know for everybody else's context, this is with Sprocket's love of futures. He keeps not pushing, but suggesting that I look into it and check it out. And futures is one of those things that it's a lot to visualize and comprehend, and I'm still struggling with it, but I definitely have a better view of its appeal in the ways that you mentioned. It just, when something goes sideways, it seems that's maybe the last thing I'm missing, is when something goes really bad, understanding what's at stake. That's probably the last part that I'm not quite comfortable with. But seems like it's not that hard to grasp. I just got to keep pecking at it.
Yeah, absolutely. It's the same concepts that we have in the equities. The one thing I would mention, one of the reasons that I like to do kind of the legging in, which is basically what I did here. I sold the one leg when we're at the one end of the range, and I sold the other leg at the other end of the range. I particularly like doing that in futures because of the way that margin is calculated. It's calculated what I would consider more intelligibly. So your margin required is exactly the same when you put both sides of the trade on. So it actually does not cost me any money to put the top side of this trade on. And that's because they understand that if you have a strangle, you cannot go in the money on both halves. You can only go in the money on one of the halves. Ironically, in Reg T margin calculations, which are used in all of the equities and indexes, ETFs, not futures, they don't take that into account, and you actually have higher margin requirements, or at least imbalance margin requirements when you put on a strangle. So it's kind of free in futures world to play both sides of the trade, but I like to keep the strikes extra wide, which is why I like to leg in to my plans when I've identified a range that a particular underlying is in. So that is what we have cooking this week, from SESN to MVIS to RTY futures. I hope that gives you guys some ideas for your own trading portfolio. If it sparks any questions, we'd love to hear them in the Discord. Log in, drop us a line, let us know what you're trading, let us know what you'd like to trade, let us know what you'd like to learn, and we'd like to cover it on Blockhead Traders Weekly. Good luck out there this week, traders, and remember, think outside the block.